Hey everyone! Have you ever been watching a chart and seen the price suddenly shoot up or down, only to whip right back around a second later? Well, those moves, they're usually not random. They're often very deliberate hunts for what's called liquidity. Today, we're going to pull back the curtain on these hidden market mechanics. We'll be breaking down the whole idea of liquidity pools, all based on an analysis from professional trader Arman Shaban. Now, he's a specialist in smart money concepts, which is all about tracking how the big institutions trade, and we're going to see how that gives us a serious edge. All right, so here's how we're going to tackle this. We'll start with the basics, the what and why of liquidity. Then we get to the fun part, the core strategy, known as the stop hunt. After that, we're going to get practical and look at step-by-step examples for both selling and buying. And we'll wrap it all up with the most important part, the key things you need to remember to actually use this in your own trading. Okay, first things first. We've got to lay the groundwork, because if you want to trade these patterns, you have to understand the why behind what the market is doing behind the scenes. So our guide on this journey is Arman Shaban. He's a professional analyst who really dives deep into what's known as ICT, or inner circle trader, and smart money concepts. Look, to put it simply, he focuses on figuring out how the big institutional players, these so-called smart money, operate. And if we can get a glimpse into their playbook, that gives us a massive advantage. So what in the world is a liquidity pool? Well, just imagine these hidden pockets of buy and sell orders all clustered together. They usually hang out around really obvious price levels, like old highs and lows that everyone is watching. Armin has this fantastic analogy for them. He calls them fuel for the market. And it's perfect, because when the price hits one of these pools, it's like lighting a match. It can set off a huge chain reaction of orders, creating those super sharp, explosive moves you see on the charts. Now, it's not all just one big pile of fuel. This stuff actually comes in two very distinct types. And, knowing the difference between them is absolutely crucial if you want to anticipate which way the market is about to get pushed. So, on one side, you've got buy-stop liquidity, or BSL for short. Just think about all the traders who are shorting the market. Where are their stop losses? They're all sitting together, right above the current price. And then, on the flip side, you have sell-stop liquidity, or SSL. These are the stop losses from everyone who's in a long position, all waiting patiently below the current price. Both of these pools act like giant magnets for the big players, which makes them the perfect targets for something called a stop hunt. And that right there brings us to the main event, the stop hunt strategy. This is the exact move that big institutions make to intentionally trigger those pools of stop orders. You see, it's not some random spike, it's a calculated play. And the best part? It's a pattern. A pattern we can actually learn to spot and, even use to our own advantage. Okay, so the big question is, how do you spot one of these stop hunts before it actually happens? Well, Armin gives us a really simple three-part checklist. First, you've got to identify the obvious levels. Major support and resistance, recent swing highs, recent swing lows. That's where all the liquidity is hiding. Second, you just watch the price as it gets close to these areas. And third, this is the big one, look for a sudden, massive spike in volume. That volume spike is your confirmation that the trap has just been sprung. All right, theory's great, but let's put this into practice. How can we actually use this whole idea of buy-stop liquidity to find a solid short trade, a sell trade? The game plan is actually pretty straightforward. It's just 3 steps. First, you find what's called the premium zone. That's just the area right above a recent high where all those buy stops are sitting. Step 2, you wait. You patiently wait for the market to spike up and grab all that liquidity. And finally, step 3, you anticipate the reversal and set your target down at an old low, because hey, that's probably where the next pool of liquidity is waiting. So here's how that actually looks on the chart. You found the buy stops just above a resistance level. You see the price spike up and bam, it triggers them all. Then comes the most important part, the reversal, a sharp move back down. That's the stop hunt right there. Your job is to enter a short position right after that reversal, with your stop loss tucked safely just above the very top of that spike. And hey, don't just take my word for it. Here's a quote directly from Arman Shaban's analysis describing this exact thing. He says, the price went up, collected the buy stops, created a reversal candle, and that gave a perfect entry point for a sell position that went on to hit the target. It's just a textbook example, really. Okay, ready? Let's flip the script. We can use the exact same logic, just in reverse, to find a great bullish setup, a buy trade, using sell-stop liquidity. You'll see the analysis here is a perfect mirror image of the bearish one. This time, you're looking for a discount zone below an old low, right where you know sell-side liquidity is trapped. You wait for the price to dip down and clear it out, and then you're looking to buy that reversal. And your target? The next logical place for the market to go, those old highs, where all the buy-side liquidity is just waiting. And the execution follows the same logic. You identify the sell stops that are sitting below a support level, you watch the price spike down, triggering all of them. Then comes the reversal, the stop hunt in action. That's your cue to enter a long position, with your protective stop loss placed just below the very bottom of that spike. And yep, you guessed it, Arman provides a perfect real-world example of this one too. The price dived down, gobbled up the sell stop liquidity, created a nice reversal candle, and gave a super clear entry for a buy position that went on to hit its target. Seeing this pattern play out in both directions just makes the whole concept click, doesn't it? So we've gone through the theory, we've gone through the setups. Now let's just boil this all down into a few core principles you can actually take with you. So what's the bottom line here? Look, your job as a trader is to basically become a liquidity detective. First, you identify the key levels where it's probably building up. Then, by knowing the difference between BSL and SSL, you can start to anticipate which direction the hunt is likely to go. And when you see that move happen, you're ready to position yourself for the powerful reversal that so often follows. But remember, this is a strategy that absolutely requires patience and discipline. And that brings us to what is, without a doubt, the most important part: risk management. This is completely non-negotiable. First, your stop loss has to be tight, placed just outside that spike to protect your capital. Second, be patient, wait for confirmation. Don't jump the gun before you see that big volume spike and a sharp reversal. And finally, please, please, never trade a new strategy with real money until you have backtested it. The market is always changing, and protecting your account is and always will be priority number one. So that leaves us with one final crucial question. Now that you can see how the big players use liquidity, how can you start looking at your own charts a little differently? How can you begin to identify these zones and anticipate these moves in your own trading starting today? Look, we've really only scratched the surface here. If you want to dive a whole lot deeper with more in-depth analysis, educational content, and daily updates straight from Arman Shaban himself, you can follow his official public channel on Telegram. Just search for Arman Shaban Trading C. I really hope this breakdown helps you see the markets in a brand new light. Thanks for hanging out with me.